Treasury General Account, the government's checking account. What is a Treasury bond, T-bond? Treasury bonds, T-bonds, are government debt securities issued by the U.S. federal government that have maturities greater than 20 years. T-bonds earn periodic interest until maturity, at which point the owner is also paid a par amount equal to the principal. Treasury bonds are part of the larger category of U.S. sovereign debt, known collectively as treasuries, which are typically regarded as virtually risk-free since they are backed by the U.S. government's ability to tax its citizens. Key takeaways: Treasury bonds, T-bonds, are fixed-rate U.S. government debt securities with a maturity range between 10 and 30 years. T-bonds pay semi-annual interest payments until maturity, at which point the face value of the bond is paid to the owner. Along with Treasury bills, Treasury notes, and Treasury inflation, protected securities, TIPS, Treasury bonds are one of 4 virtually risk-free government-issued securities. Treasury bond. Understanding Treasury bonds, T-bonds. Treasury bonds, T-bonds, are one of 4 types of debt issued by the U.S. Department of the Treasury to finance the U.S. government spending activities. The 4 types of debt are Treasury bills, Treasury notes, Treasury bonds, and Treasury inflation protected securities, TIP. These securities vary by maturity and coupon payments. All of them are considered benchmarks to their comparable fixed income categories because they are virtually risk-free. T-bonds are backed by the U.S. government, and the U.S. government can raise taxes and increase revenue to ensure full payments. These investments are also considered benchmarks in their respective fixed income categories because they offer a base risk-free rate of investment with the category's lowest return. T-bonds have long durations, issued with maturities of between 20 and 30 years. 2. As is true for other government bonds, T-bonds make interest payments semi-annually, and the income received is only taxed at the federal level. Treasury bonds are issued at monthly online auctions held directly by the U.S. Treasury. A bond's price and its yield are determined during the auction. After that, T-bonds are traded actively in the secondary market and can be purchased through a bank or broker. Individual investors often use T-bonds to keep a portion of their retirement savings risk-free, to provide a steady income in retirement, or to set aside savings for a child's education or other major expenses. Investors must hold their T-bonds for a minimum of 45 days before they can be sold on the secondary market. Special considerations: Treasury bond maturity ranges. Treasury bonds are issued with maturities that can range from 20 to 30 years. They're issued with a minimum denomination of $100, and coupon payments on the bonds are paid semi-annually. The bonds are initially sold through an auction. The maximum purchase amount is $5 million if the bid is non-competitive, or 35s of the offering if the bid is competitive. 3. A competitive bid states the rate the bidder is willing to accept. It is accepted depending on how it compares with the set rate of the bond. A non-competitive bid ensures the bidder gets the bond, but they have to accept the set rate. After the auction, the bonds can be sold in the secondary market. The Treasury bond secondary market. There is an active secondary market for T-bonds, making the investments highly liquid. The secondary market also makes the price of T-bonds fluctuate considerably in the trading market. As such, current auction and yield rates of T-bonds dictate their pricing levels on the secondary market. Similar to other types of bonds, T-bonds on the secondary market see prices go down when auction rates increase because the value of the bond's future cash flows is discounted at the higher rate. Inversely, when prices increase, auction rate yields decrease. Treasury bond yield. In the fixed income market, T-bond yields help to form the yield curve, which includes the full range of investments offered by the U.S. government. The yield curve diagrams yield by maturity, and it is most often upward sloping, with lower maturities offering lower rates than longer, dated maturities. However, the yield curve can become inverted when long. Term rates are lower than short-term rates are lower than short-term rates. An inverted yield curve can signal an upcoming recession. Treasury bonds Vs. Treasury notes Vs. Treasury bills. What's the difference? Treasury bonds Vs. Treasury notes Vs. Treasury bills. An overview. The federal government offers fixed income securities to consumers and investors to fund its operations, including Treasury bonds, Treasury notes, and Treasury bills. Treasuries are debt instruments in which investors are lending the U.S. government the purchase amount of the bond. In return, investors are paid interest or a rate of return. When the bond matures or maturity date, investors are paid the face value of the bond. Treasury bonds, notes, and bills have different maturity dates and can pay interest in different ways. However, all treasuries have zero default risk, meaning they are guaranteed by the full faith and credit of the United States government. However, the safety offered by treasuries comes with a lower return on investment than their alternative, riskier counterparts, corporate bonds. 1. Treasury yields can rise and fall depending on the market and economic conditions. For example, yields fell significantly during the COVID-19 pandemic of 2020. 2. Key takeaways. Treasury bonds, treasury bills, and treasury notes are all government-issued fixed income securities that are deemed safe and secure. T-bonds mature in 20 or 30 years and offer the highest interest payments bid annually. Notes mature anywhere between 2 and 10 years with biannual interest payments but lower yields. T-bills have the shortest maturity terms, from 4 weeks to 1 year. These investments are auctioned off regularly on the US Treasury's website, Treasury Direct. This investment will remain a boomer's best friend. Treasury bonds. Treasury bonds, called T-bonds for short, are often referred to as long bonds because they take the longest to mature of the government issued securities. Treasury bonds are offered to investors in terms of 20 and 30 years to maturity. Treasury bond characteristics. Purchasers of T-bonds receive a fixed interest payment every 6 months. Upon maturity, the investor is paid the face value of the bond. 4. Treasury bonds pay the highest interest rates compared to Treasury notes and bills because investors are compensated for locking their money up for the longer term. For the same reason, the prices at which they are issued fluctuate more than the other forms of government investment. Treasury bonds are issued at monthly online auctions held directly by the US Treasury, where they are sold in multiples of $100. A bond's price and its yield are determined during the auction. After that, T-bonds are traded actively in the secondary market and can be purchased through a bank or broker. 4. What to do at maturity. Investors can hold the bond until it matures and redeem it for cash on the maturity date, or they can sell the bond in the secondary market before it matures. However, the face value is not guaranteed if the bond is sold before maturity, meaning investors could incur a loss when comparing the purchase price and sale price. Investors must hold their TB bonds for a minimum of 45 days before they can be sold on the secondary market. 3. Investors with a Treasury Direct account can have the proceeds direct deposited to their bank account on file with the Treasury at maturity. Investors can also reinvest the proceeds into another Treasury instrument via Treasury Direct. Those who have Treasury bonds held by their bank or broker should contact those institutions to determine their redemption procedures. 5. Benefits of Treasury bonds. Individual investors often use T-bonds to keep a portion of their retirement savings risk-free and to receive a steady income in retirement. Treasury bonds can also be used as savings for a child's education or other major expenses. Many retail and institutional investors use Treasury bonds to diversify an equity portfolio so that the bonds offer reduced risk and volatility while providing a stream of income. 3. Treasury bonds, notes, or bills sold before their maturity date could incur a loss, depending on bond prices at the time of the sale. In other words, the face value is only guaranteed if the Treasury is held until maturity. Treasury notes. Treasury notes are similar to Treasury bonds but have shorter terms, including 2, 3, 5, 7, and 10 years. Like T-bonds, Treasury notes are backed by the U.S. government. 6. Treasury note characteristic. Treasury notes, or T-notes, pay interest every 6 months until they mature. Typically, Treasury notes pay less interest than T-bonds since T-notes have shorter maturities. Like T-bonds, the yield is determined at auction and upon maturity. Treasury notes pay the face value of the bond. 7. Treasury notes also are auctioned by the US Treasury and are sold in $100 increments. The price of the note may fluctuate based on the results of the auction. It may be equal to, less than, or greater than the note's face value. Investors have the same redemption options as Treasury bonds, and T-notes can be held until maturity or sold in the secondary market before they mature. 6. Importance of Treasury notes. The 10-year T-note is the most closely watched government bond. It is used as a benchmark rate for banks to calculate mortgage rates. Typically, the 10-year note is in high demand since it's often used as a safe haven investment to reduce the volatility in an investment portfolio. During times of recession and market uncertainty, the demand for the 10-year can increase significantly, leading to fluctuations in bond prices and yields. Conversely, during economic expansions, investors may sell their 10-year notes and opt for higher-yielding bonds since there's a reduced risk of loss during expansionary business cycles. However, the 10-year is extremely popular with institutional and retail investors as well as central banks and governments. As a result, there is a healthy, steady demand for the 10-year note, providing ample liquidity. Treasury bills. Treasury bills, or T-bills, have the shortest terms of all and are issued with maturity dates of 4, 8, 13, 26, and 52 weeks. 8. Treasury bill characteristics. Unlike Treasury bonds and notes, T-bills do not pay periodic interest payments to investors. Instead, Treasury bills are auctioned off to investors at a discount to their face value. The investor's return is the difference between the face value and the discount price paid at purchase. 9. For example, an investor might purchase a Treasury bill with a $1,000 face value for a $950 purchase price. At maturity, the investor is paid $1,000. The $50 difference between the $950 purchase price and the $1,000 face value is considered the interest. Just like Treasury bonds and notes, T-bills have zero default risk since they're backed by the US government. As a result, T-bills tend to pay less interest than corporate bonds since corporate bonds have the potential of defaulting, which leads investors to demand higher interest from corporates to compensate for the added risk. Cash Management Bill, CAM. The US Treasury also offers a short-term security that is a lot like a T-bill called a Cash Management Bill, CAM bill. The main difference between the two is that a CAM-B has a much shorter maturity date, ranging anywhere between 7 days to 3 months. CAMs can also be purchased in $100 increments. 10. 11. Investors can direct their federal tax refund to an active Treasury Direct account to purchase securities. Special considerations. Treasury auctions. These securities are sold through auctions by the U.S. Treasury on its Treasury Direct website. 12. Demand helps set their rates and yields during auctions, and, as mentioned above, their values fluctuate with interest rate changes and market demand. All auctions are open to the public and can be found on the Treasury's list of upcoming auctions. Individual investors can purchase securities directly through the auction process or a broker or bank. Auctions are announced several days before they begin, with the amount to be auctioned and its maturity date. Participants have 2 bidding options. Competitive bids. With this type of bid, you can set the rate, yield, or discount margin acceptable. Competitive bids are limited to 35s of the offering amount. Non-competitive bids. Here, you agree to the high rate, yield, or discount margin set during the auction. Bidders are limited to $5 million per auction with non-competitive bid. 12. The Treasury also auctions additional amounts of previously issued securities called reopened securities. Like the original security, reopened ones have the same maturity date and interest rate issued securities. The only difference between the two is the issue date and the price. Tax information. Along with being unlikely to default, there is another similarity these 3 types of investments share: their tax implications. The interest income investors earn from T-bonds, T-notes, and T-bills is only taxed at the federal level. 13. That means the income is exempt from both state and local taxes. All investors who hold federal securities receive a 1099 form. For any security held at Treasury Direct, as much as 50s of the interest earnings can be withheld in order to ease an investor's tax burden. Investors can specify how much they want to be withheld online. 13. Investors who want more information can get more information from the research division of the Treasury Direct website. How do you cash a Treasury bond? For Treasury bonds held with a bank or broker, consult the institution to redeem them. For Treasury bonds in Treasury Direct electronically, investors don't need to take any action since the bond will be cashed out at maturity and deposited into your account as long as you supply your bank information to Treasury Direct. Treasury bonds in paper form can be redeemed when presented to Treasury Direct. Call the Treasury for details, or if you have questions, at 844 284 284 2676 all free. 14. What is riskier, Treasury bonds or Treasury bills? Treasury bonds, notes, and bills have zero default risk since they're guaranteed by the U.S. government. Investors will receive the bond's face value if held to maturity. However, if sold before maturity, a gain or loss can occur depending on the difference between the purchase and sale price of the Treasury. How do I buy Treasury bonds? Treasury bonds can be purchased directly from the US Treasury via Treasury Direct or through a bank, broker, or dealer. If through the Treasury, you'll need to open an account online with the Treasury and have a bank account linked to make the purchase. 15. When should I invest in Treasury bills, Vs, bonds? Whether to invest in Treasury bonds or bills often depends on the investor's time horizon and risk tolerance. If the money will be needed in the short term, a Treasury bill with its shorter maturity might be best. For investors with a longer time horizon, Treasury bonds with maturities up to 10 years might be better. Typically, the longer the maturity, the higher the return on investment. Treasury inflation, protected securities tips explained. What are Treasury inflation, protected securities tips? Treasury inflation, protected securities tips are a type of Treasury security issued by the U.S. government. TIPS are indexed to inflation to protect investors from a decline in the purchasing power of their money. As inflation rises rather than their yield increasing, TIPS instead adjust in price, principal amount, to maintain their real value. Key takeaways. Treasury inflation, protected securities TIPS are a type of Treasury bond that is indexed to an inflationary gauge to protect investors from a decline in the purchasing power of their money. The principal value of TIPS rises as inflation rises, while the interest payment varies with the adjusted principal value of the bond. The principal amount is protected since investors will never receive less than the originally invested principal. Treasury inflation, protected securities TIPS. Understanding Treasury inflation, protected securities TIPS. The principal value of TIPS rises as inflation rises. Inflation is the pace at which prices increase throughout the U.S. economy, as measured by the Consumer Price Index, PPI. Inflation becomes an issue when there isn't a commensurate rise in real wage growth to offset the negative effects of rising prices. 1. TIPS are a popular asset for protecting portfolios from inflation and profiting from it because they pay interest every 6 months based on a fixed rate determined at the bond's auction. However, the interest payment amounts can vary since the rate is applied to the adjusted principal or value of the bond. If the principal amount is adjusted higher over time due to rising prices, then the interest rate will be multiplied by the increased principal amount. As a result, investors receive higher interest or coupon payments as inflation rises. Conversely, investors will receive lower interest payments if deflation occurs. 1. TIPS are issued with maturities of 5, 10, and 30 years and are considered a low-risk investment because the U.S. government backs them. At maturity, TIPS return the adjusted principal or the original principal, whichever is greater. TIPS can be purchased directly from the government through the Treasury Direct system in $100 increments with a minimum investment of $100 and are available with the aforementioned maturities. Some investors prefer to get TIPS through a TIPS mutual fund or exchange traded fund ETF. However, purchasing TIPS directly allows investors to avoid the management fees associated with mutual funds. TIPS price relationship to inflation. TIPS are important since they help combat the inflation risk that erodes the yield on fixed-rate bonds. Inflation risk is an issue because the interest rate paid on most bonds is fixed for the life of the bond. As a result, the bond's interest payments might not keep up with inflation. For example, if prices rise by 3 and an investor's bond pays 2, then the investor has a net loss in real terms. TIPS are designed to protect investors from the adverse effects of rising prices over the life of the bond. The par value, principal, increases with inflation and decreases with deflation as measured by the CPI. As mentioned earlier, when TIPS mature, bondholders are paid the inflation, adjusted principal or original principal, whichever is greater. Suppose an investor owns $1,000 in TIPS at the end of the year, with a coupon rate of 1. If there is no inflation as measured by the CPI, then the investor will receive $10 in coupon payments for that year. If inflation rises by 2, however, then the $1,000 principal will be adjusted upward by 2 to $10-20. The coupon rate will remain the same at 1, but it will be multiplied by the adjusted principal amount of $10-20 to arrive at an interest payment of $10-20 to arrive at an interest payment of $10.20 for the year. Conversely, if inflation were negative, known as deflation, with prices falling 5, then the principal would be adjusted downward to $950. The resulting interest payment would be $9.50 over the year. However, at maturity, the investor would receive no less than the principal amount invested of $1,000 or an adjusted higher principal, if applicable. 1. The interest payments during the life of the bond are subject to being calculated based on a lower principal amount in the event of deflation, but the investor is never at risk of losing the original principal if held to maturity. If investors sell TIPS before maturity in the secondary market, they might receive less than the initial principal. 1. TIPS don't work as a short-term hedge against spikes in inflation. Their real function is to protect investors against rising living costs over the long term. How to buy TIPS. As with other Treasury securities, investors can buy TIPS directly from the U.S. government at the Treasury website Treasury Direct site. Treasury Direct Gov. This entails a somewhat complicated login process with several security layers. 1. You can also buy TIPS directly from your bank or broker. This may be more convenient for those investors who already have a substantial portfolio of securities at a certain financial institution. Advantages and disadvantages of TIPS. While TIPS are an attractive prospect for investors who expect high levels of inflation, they are at a disadvantage to other types of debt during periods of ordinary inflation. Below are some other considerations to keep in mind. Lower yield. TIPS usually pay lower interest rates than other government or corporate securities, so they are not necessarily optimal for income investors. Their advantage is mainly inflation protection, but if inflation is minimal or non-existent, then their utility decreases. Tax considerations. Like other Treasury bonds, the interest and inflation adjustments on TIPS are exempt from state and local income taxes. However, the inflation adjustment is considered taxable income by the Internal Revenue Service, IRS, even though investors don't see that money until they sell the bond or it reaches maturity. 2. Some investors hold TIPS in tax-deferred retirement accounts to avoid tax complications. However, it may be worth contacting a tax professional to discuss any potential tax ramifications of investing in TIPS. Plus, the principal increases with inflation, meaning that at maturity, bondholders are paid the inflation-adjusted principal. Investors will never be paid less than their original principal when TIPS mature. Interest payments increase as inflation increases, since the rate is calculated based on the adjusted principal balance. Cons. The interest rate offered is usually lower than most fixed income bonds that do not have an inflation adjustment. Investors might be subject to higher taxes on increased coupon payments. If inflation does not materialize while TIPS are held, then the utility of holding TIPS decreases. Example of TIPS. Below is a comparison of the 10-year TIPS to the 10-year Treasury note, both issued and auctioned by the US Treasury Department. Treasury notes T notes are intermediate term bonds maturing in 2, 3, 5, 7, or 10 years. They provide semi-annual interest payments at fixed coupon rates. 3. As a historical example, on March 29, 2019, the 10-year TIPS was auctioned with an interest rate of 0.875. 4. On the other hand, the 10-year Treasury note was auctioned on March 15, 2019, with an interest rate of 2.625 per year. 5. We can see that the 10-year note pays more interest, meaning that investors will receive higher coupon payments from the 10-year note compared to the TIPS investment. However, if inflation rises, then the principal on the TIPS will increase, allowing for the coupon payments to rise, while the 10-year note is fixed for the life of the bond. Although TIPS protect against inflation, the offset is typically a lower yield than bonds with similar maturities. How did TIPS perform in 2022? In 2022, inflation in the United States hit highs not seen in 4 decades, leading many investors to flock to TIPS for protection. However, that insurance policy didn't really go according to plan. These inflation-protecting securities fell an average of 14.2 during the course of the year, performing not much better than regular treasuries and major equity markets. 6. This serves as a reminder of how tips work and how they are often misunderstood. When inflation soared in 2022, the Federal Reserve, as it normally does when the cost of living rockets, hiked interest rates, and steep increases in the cost of borrowing caused tips, like the rest of the bond market, to plummet in value despite the extra payouts tied to inflation. What 2022 taught many investors is that tips carry the same underlying interest rate risk exposure as other bonds and therefore are not the pure play inflation hedge that some people may have thought they were. Many were fooled into thinking that tips returns are perfectly correlated to changes in inflation. Hopefully, they have learned their lesson. Tips are designed to protect investors against inflation over the long term rather than act as a short-term hedge against soaring prices. How can I buy Treasury inflation? Protected securities tips. You can buy tips directly from the US Treasury's Treasury Direct website with a minimum purchase of $100. You can also typically buy them through your broker. There are also several mutual funds and exchange-traded funds, ETFs, that invest in tips and other inflation-linked securities that you can buy and sell like ordinary shares of stock. Can I buy tips for my individual retirement account, IRA? Yes, you can include tips and funds that hold tips in an individual retirement account. IRA, however, you cannot use the Treasury Direct service to buy them directly in an IRA. Instead, you would need to rely on the broker holding your retirement account. What yields do tips have? The yields on tips are often negative. This is because after taking into account the effects of inflation, the real yield is negative. For instance, if standard 2-year treasuries yield 1, but inflation is 2, then the real yield is 1. Tips are meant to keep up with inflation, not beat inflation. Therefore, you can have a nominal yield on tips that is positive, but a real yield that is effectively 0. Note that while the yield on tips may be negative, their principal value will increase with inflation, which can generate capital gains. Why does the Treasury issue tips? Tips first appeared in 1997. The official reason for their appearance is that there was strong demand from the investing public for inflation-linked government securities. 7. However, some economists have been puzzled by the government's continued issuance of tips since they amount to a more expensive way to borrow than traditional treasuries. 8. What maturities do tips come in? The original tips were set at 20-year maturities. In 2009, 20-year tips were discontinued in favor of 30-year tips. The US Treasury currently issues 5, 10, and 30-year tips. 7. The bottom line. Tips are among the many types of debt securities offered by the US Treasury Department. You can think of them as treasuries with a twist. Their principal value is tied to inflation to protect investors when the cost of living rises. However, they are often misunderstood. It's important to know that inflation protection comes at a cost, as most of these securities carry lower interest rates than other similar government bonds. Also, bear in mind that at the time of maturity, bondholders are paid the inflation, adjusted principal or original principal, whichever is greater. In other words, there's protection in place for instances when there's lots of deflation. Another common misconception is that tips are guaranteed to do well when inflation is rising and function as a great short-term hedge when the cost of living suddenly spikes. As 2022 taught us, tips are bonds at the end of the day, and bond markets react badly to rising interest rates.